Hello and welcome to NDTV Profit. This is Anushi, Vakharia, and today's company in focus is Kalpataru Projects International on the back of their Q1 FY25 results. To discuss more on this, we have Mr. Amit Uplenchwar, the director of the company, joining in with us. Hello and welcome to the show, Mr. Uplenchwar.
Hi, Anushi. Nice to be on your show. Thanks for having me.
Hi Amit. So my first question is on the quarter results. Now you've reported a 8% of a revenue growth here. While if you look at the net profit, they were about 20. We saw about a 25% dip. Again, there was election period going on, which has resulted in this. But now going forward in FY25, you have maintained a revenue guidance of about 20%. How are we looking at the execution? Are we expecting a ramp up in the next 3 quarters going forward?
So, Anushi, as you correctly mentioned, this quarter was an exceptional quarter in terms of a very protracted, long election, because of which, most of the government projects slowed down. There was a severe heat wave in addition to that, and a lot of the labor just was not available. This was faced by industry at large. Having said that, July already, most strength has started to come back, and we believe by August, we should be on full strength. And so third, fourth quarter, we expect for revenue to bump up, and so we'll be able to maintain that 20% at the end of the year as our revenue growth compared to last year.
Okay, so quarter 3 and quarter 4, definitely the quarters to watch out for going forward. Now, what's interesting here is the key metric which you use, that is the PBT guidance, which is about 4.5 to 5%, while your EBITDA margin guidance is about 8.5 to 9%. I want to understand, there was a one point which we saw in the presentation about the new order secured. They have better profitability going forward. So barring FY25 onwards, if we consider the next 1 to 2 years outlook, how do we see this inching upwards?
So, even now, if you see our Q1 standalone result, our PBT is at 4.4%, in spite of, a little bit of lesser revenue than guided for Q1 because of all the factors that we just discussed. I think the last 2-3 years in our energy sector, the transmission saw a dip, but for the last 6-8 months, there is a huge inflow of orders in transmission. The margins are getting better. And I think, as you mentioned, our expectation is that, as we said, we'll be in 4.5 to 5%, but going from 26 onwards, I think we should be at the upper band of that guidance and hopefully get to 5% and beyond in FY26, given that the inflow of orders is at better margins than they were the last few years.
And just a follow-up on that, what about the EBITDA margins? Can we see them going back to the 11% range?
So, we've said that because we are a diversified EPC contractor across so many sectors, right? Some have very large capex. So, for example, in urban infra, when you buy tunnel boring machines and very large HDDs, etc., your capex is very high in 1 year, depending on the kind of projects that you win. I think the right way to look at a diversified EPC business, whilst we'll try and get to a bit of 9 to 10% in the quarters to come next year. But I think if you look at from a balance sheet strength perspective, if my net working capital days are below 100 and my interest cost as a percentage of my revenue is maintained at 2% thereabouts, and my PBT is in the range of 4.5-5% and hopefully get to 5% and a little more than that, you are getting a company with a very strong revenue growth, balanced, balance sheet, which is very, very strong, and a very profitable bottom line. I think these 3 outcomes in conjunction is what our focus is going forward, given that CapEx varies from type and kind of projects that we win. So that is where our focus is and will continue to be going forward.
Absolutely, that's fair. Now I want to come to your order inflow guidance that you've given. That stands at about 22 to 23,000 crore as mentioned in your conference call. Now I want to understand here, we've already secured about 12,000 crore, including the L1 if we are to see that. Are we under promising? Is this a conservative guidance that we are looking at, considering that you've already you're already seeing a stronger second half? That's the quarter 3 and quarter 4. Also, you are expecting a bump up there. So, what's your outlook on this?
So, our quarter 3, quarter 4 bumpers was from a revenue standpoint because we have a large order book. This second quarter is also typically a monsoon quarter. So, Q3, Q4 are for the best for the EPC industry. So when I mentioned a bump up was more from a revenue standpoint, we already have a order book which is far in excess of 50,000 crores, which gives us a 2.5 year kind of order revenue visibility already. Whilst we are winning these orders, the focus, like you mentioned, for FY26-27 is to further increase our already one of the best industry sets in the margin to go further. And for that, our focus has to be on bottom line. And today, bottom line is not just winning orders, but for us to execute them very well. And for that, we need resources in terms of people. We need to invest in capex. We need to augment our engineering capability as our projects become larger and larger and more complex in size. And I think from that standpoint, while we already have a good order book, we have revenue visibility, we are happy doing a 23,000 crore order inflow this year, but with margins that are higher than what it would be otherwise. So that, in the years to come, we can increase our bottom line percentages even further. And that's what the focus is. If we get more than that, that's fine. But our focus is to take projects with better margins and ensure that our execution doesn't falter, so that we continue with our 20% growth rate for the next few years to come, but with a very, very solid balance sheet and strong profitability.
And are we seeing more international orders coming in from the order guidance that you've mentioned? Because last year, if we see, it was a heavy order flow in terms of international business. We saw a lot of orders coming from the Middle East. What's the outlook for this year? Which are the segments that we should be watching out for?
So, for us, oil and gas looks very promising. If you look at our order book inflow, we've been at 64% domestic and 36% international. And if I look at the order book split that I have today, roughly domestic is around 54% and the rest is international. Our endeavor is to try and keep this balanced. However, looking at a very, very strong pipeline of transmission projects, both in India and overseas, I think India will continue to do well as well in the transmission sector. The oil and gas sector overseas is looking very, very promising. As you know, we've got a huge contract for Saudi Aramco, and we will continue to build on that. The water business, which was slow this quarter, but I think it was just because of elections and all the clients being government. The budgetary allocations will start again. So water business looks, very, very promising in the next few years to come. Building and factories is seeing an unprecedented growth in, complex buildings, high rises, a lot of factories coming up, things like PLI, etc., are helping that manufacturing sector in India. So I think barring railways, where the competitive intensity has gone to a level where, we are consciously tempering our order inflows there because the margins are simply not there. The rest of all our divisions are seeing heavy growth, both in terms of order booking as well as future opportunity set that we can see today for the next at least 3 to 5 years. So that's where we are today on our sectoral, outlook for the next few years.
Okay, so strong performance going for all your business segments, barring the railways, of course. Now, again, if I want to see I just want to touch upon the water segment that you've mentioned. We did see about a decline. How is it looking from July, August onwards? Is there a recovery that we are seeing over here? What's the current outlook in this one?
So the recovery has already started happening, as I mentioned earlier. And hopefully from August onwards, our water budgetary allocations already are happening, and fund flows have started from various state governments for all our projects. So I don't see a challenge for the water business in the Q3, Q4, and hopefully by the end of the year we should see growth in that as well. If you see our revenue growth in our transmission business at overall both India and overseas is close to 32% compared to last year. Our ONG business has grown at 20%. Our building division has grown in excess of 20%. So everywhere there is revenue growth in excess of 20%. Our railway business, of course, dipped in terms of revenue, and water was exceptional only for this quarter where we had a dip of 18%. But otherwise, going forward, we don't see that as a challenge. Things have already started moving on our projects in the water division. So by the end of the year, I think 20%, which we had started as a target at the beginning of the year, we'll achieve for sure.
All right, that's one to watch out for. Now I want to come to your net debt. So again, because of these delayed collections, we did see the net debt going upwards to 3,739 crore. If I were
Right.
to get a sense of the overall FY25 outlook, do we expect a reduction going forward in this number?
We most certainly will see a reduction going forward. Our collections have started improving again, as I said, as fund flows have started. Q3, Q4 looks robust from a revenue standpoint. And as we started at the beginning of the year with net working capital days getting down under 100 and our interest costs coming down again in Q3, Q4, bringing the whole year interest cost as a percentage of revenue back below 2 or 2% and below. I think we should be in debt levels which we've always maintained as a percentage of our revenue. So I don't see that as a challenge towards the end of the year. So it's just seasonal for Q1.
Okay, so net debt going downwards from this point onwards. All right, my last question is on the promoter pledge levels. Now, there has been some discussion on this, but in this quarter, we have seen it going down to 28%. I want to understand it from you. What is it? Are we expecting a further decline in this one also, and how is it looking overall for this one?
We've for the last 2 years, I've been answering this question saying that the promoter pledge will keep going down. If you see our pledge, the promoter pledge levels from where they were 2 years ago, from where they are now, they've come down significantly. In fact, now for a long time they've been under 30% as they stand today at 28.8%. I'm from what I've been given to understand, as we've been saying all along, that this pledge percentage is not going to go up further. Uh, Whether it'll go down and by how much is something that we still need to see. But for sure, I can, commit on, as we know from shareholders, that I don't think the pledge number is going up from this percentages anytime soon.
Well, that was my final question. Thank you once again, Amit Uplenchwar, for joining us and sharing your Q1 FY25 insights on Kalpataru projects. Thank you so much for joining in.
Thank you so much. Thank you so much for having me.